Morning, everybody, and welcome to the summer energy market update. This is the first one that we're doing, and it's going to be a series of three. So this is session number one, just before the summer break, and we thought it'd be a really good opportunity to talk about the markets and what's going on in energy right now. Just to talk you through the agenda, I'm going to give a little bit of an idea about a market snapshot and wholesale gas and power prices and what's going on currently in 2026. Then we're going to talk about what's affecting those prices, so things like geopolitical risk, LNG supply and demand, and the storage dynamics that we're seeing, particularly in Europe at the moment. Then we'll touch on what the further outlook, the forward curve prices are looking like for 2027 and 2028. And what that means for you and any practical takeaways and bits and pieces as well. So again, any questions at all, just let me know. I'll just introduce myself. My name's Nick Gauntlet. I am relatively new to ARO. I've been here just over a month, but I've been in energy for just over 20 years in sales and procurement. Dealt with customers and looked after customers into Nando's and lots of public sector customers, Manchester Airport, and some large hospitals and universities as well. So I have been around the block a little bit. You'll be pleased to know as well, I'm not going to talk about football at all today. So we will keep that, particularly after last night's game. So nothing about that, all about gas and power today. So it gives you a little bit of an idea. Just on to the next slide. A bit about ARO. We've been going for over 25 years. We're a trusted enterprise performance partner, and ARO delivers sustainability solutions that help organizations reduce energy costs, improve operational efficiency, and accelerate towards Project Net Zero. We've got over 8 offices across the UK, and our sustainability office is in central London with our great team there. There's over 400 employees in ARO, and we've got over, I think it's 22 people in our sustainability team now. We managed over a terawatt of energy management, and it's over 3,500 meters that we manage proactively for all our customers at the moment. Over the years, we've recovered over £5 million worth of billing mistakes as well. So looking into those detailed bits and pieces, helping support our customers with all those extra value-added services as well. And we've got our award-winning monitoring and reporting service pod that is available to our customers 24/7. So that is always there for people as well. So we are a complete consultancy service, end-to-end support for all our customers. We support you through your net zero journey. That's all your audit planning, commitment, monitoring and reporting, and your compliance bits and pieces there. We obviously look after energy procurement. That will be from your fixed contracts through flexible, corporate power purchasing agreements, risk management strategies and contract tendering. We look very detailed into the market research and intelligence and really help and support when people should renew and look after and complete their procurement. We also look after water procurement as well. We look after energy optimization, so on-site audits, desktop audits, and KVA analysis as well. So again, full suite of services to help support our customers. Energy compliance, so EPCs, ESOS, CCAs, SECA, and TCFDs as well. And then last but not least, our amazing account management team. I've worked for some really big companies over the years, and honestly, our account management team are brilliant. They really support and look after our customers. So I'm extremely pleased to have joined the team and working alongside them. But we look after monitoring and metering, bill validation, trading reports, cost recovery, renewal timeline, and budgeting and forecasting support. So while we're all here, I'm not here to scare anybody. It's here to give you some information about what's happening in the markets currently and why the markets are so sort of volatile at the moment. And when I say volatile, it means we're having lots of spikes, but as quickly as prices are rising at the moment, they're also falling, and it's all event driven. The volatility has come in spikes, and it's around specific news. So it's particularly around the geopolitical tensions in Iran with America and everything that's going on at the moment. So it's just to give you a little bit of an idea. What we are not seeing is a real gradual increase in prices month on month on month. What we are seeing is very large spikes that then drop back down given bits and pieces in the news at the moment. What we have seen, if we were looking at prices at the beginning of the Iran conflict around February time, middle of February, prices have risen right now for a similar time period around, it's about 40%. And from that, from May, is another 20%. Now, that is the very near term prices right here and now. If you were to go and get a contract on the day ahead prices, that's what we're starting to see. However, we are seeing 2027 and 2028 periods not rising anywhere near as much as that. That's where the value is currently sitting. It's not to say that you should go out and do a big 5-year contract, but it is to make you aware that the actual pricing and where the value is right now is a little bit further out than the real near time risk of between now and Christmas. So why are we seeing all these spikes and swings? We had an initial cold snap right in Q1, and then obviously we had the tensions in Iran and the issues that we've seen with the Strait of Hormuz. That all happened in February, and we saw the markets very quickly mirror very slightly what we saw from Russia and Ukraine a number of years ago. Now, I just want to add that we haven't seen the huge increase in prices that we saw in that conflict. That was based upon supply, and we're not seeing that at all. We've still got plenty of gas and electricity. The supply is not an issue. It's much more around news stories, what's going on in the near time right here and now. In June, the MOU, which is a memorandum of understanding, it was signed between America and Iran as an effective ceasefire. They were going to open up the Strait of Hormuz and let all the LNG shipments come through. However, what we're seeing and why we're seeing some of these spikes now is that Iran then started to attack more shipments again, and President Trump turned around and said, right, we're tearing up the ceasefire, it's going. However, we have seen in the last couple of days that Trump is open to coming to the table again and negotiating a new ceasefire. And as soon as those words sort of come out of his mouth, we're starting to see prices dip back down again. So it is very much about keeping an eye on the markets, seeing what's happening, and keeping our customers informed about the right time to go to market and managing these spikes and dips as best we can. We're also keeping a very close eye on the autumn storage refill. We are seeing a lot of competition for LNG shipments, liquid nitrified gas, from Asia. They are desperate to use a lot of that to help with their sustainability bits and pieces they're doing at the moment, and they are buying up all the shipments. So I will go into that in a little bit more detail on a coming slide. So yes, what we are seeing with prices is near-term prices between now and Christmas are very volatile. We are seeing lots of peaks and troughs. However, further outlook we go into 2027 and 2028, prices are looking much better, and that's where the value is looking at the moment. So just to give you a bit of an idea. Into the next slide. So, geopolitical risk. We're talking about Iran. We're talking about the Strait of Hormuz, that sea that sits just underneath Iran, and the supply security. Why is it affecting our prices so much? So, Persian Gulf, a little bit further up from the Strait of Hormuz, we've got Qatar, and Qatar produces around 25% of the LNG, liquid nitrified gas, that the world needs. And those shipments come out of Qatar into the Persian Gulf, and then they would travel round the Strait of Hormuz. The issue that we're seeing is Iran is effectively using that strait and blockading it and stopping shipments coming through, which then spikes prices around the world. Because if 25% of the LNG shipments around the world are stopped and sitting effectively in that Persian Gulf and not allowed to come through, we start to see prices rise, because we've then got Asia buying up a lot more of the other shipments around the country, around the world, and we're starting to see the demand for those and prices rise. We're keeping a very close eye on things. So there is no easy reroute around the Persian Gulf. It's kind of one way in and out. There's not a lot of other transit areas what we can do. Even a brief disruption spikes. So as soon as we start to see Iran attacking shipments there, then suddenly we're starting to see insurance costs for those particular ships, and the prices rise quite considerably. But what I will say is, as soon as it stops and a ceasefire is agreed, which it has done in June, we see the prices come back down relatively quickly, which is positive. We're keeping a close eye on it. So naval and military activity near the Strait, what's going on, what's been agreed, what hasn't. We keep seeing agreements in place, and then we start to see them being broken again. So it's just keeping a really close eye and making sure everyone's aware of why the prices are rising or falling like that. We keep a close eye on Iran's ongoing compliance signals under the Memorandum of Understanding. And we're taking into consideration the tanker insurance premiums for transit through the Straits as well. All that starts to feed into the prices that we see they come through on the commodity costs that we look at in the markets. What I'm going to say is reduced risk. So the reduced isn't resolve risk. What we do see is if a ceasefire is agreed and everything else, the prices do fall, which is great. But what we are seeing is things can very quickly change up again. What we will really help prices is if the war and the tensions are agreed and everything goes away. But what we have to be a bit careful of is if shipments still coming through the Strait and they're allowed through the Strait, prices will dip. But it would just hit another attack, something along those lines, another bombing, the prices would then jump up very, very quickly. So what we're just saying to all customers, look, cover yourself for the winter, it's coming up, but let's look at 27 and 28 and see what the best strategy is for you. Not every customer wants to look at 2 or 3 year contracts and looking at that, but that's kind of where the value is at the moment. It might mean having a short-term contract and then looking at the prices going forward into 27 and 28 as well. So lots of opportunity for every customer of all different shapes and sizes that we can help and support. So then I'm going to talk a little bit about LNG supply and demand. There's a lot going on with this as well, particularly as we've seen Qatar and those shipments effectively stopping. So if we take away 25% of the LNG shipments in the world, prices for those shipments do rise quite considerably. What we are starting to see is there has been an agreement over the next few years that LNG supply is really increasing, and that is helping those 27 to 2028 prices, which is great. Asian demand growth is absorbing a lot of cargoes at the moment, though. Asia is effectively buying cargoes at any price. They are willing to spend a lot more money than what Europe is at the moment on those shipments. And what it is then having is a knock-on effect on European pricing. We're then not filling our storage up as quickly as we should be, which I'm going to talk about in a minute. And it's having a knock-on effect. So those LNG shipments, Europe is effectively being outbid by Asia. What we do see is a shipment, it looks like it's going to dock into Europe, and then a price which is much higher comes from either China or Japan, and that shipment effectively turns around and then starts heading off towards Asia because they're going to get a lot more money for that shipment. So the owners of those LNG shipments are going to want to get the best possible price. And if Asia are willing to pay it, that's what's happening at the moment. We are really seeing, particularly in this graph here, China's monthly energy imports are really starting to surge at the moment. They are buying up everything that is out there, and they're willing to pay any price for that. So we're keeping a very, very close eye on that. What it is having a knock-on effect on European storage. Effectively, what we tend to do is use that LNG to dock into Europe and fill up European gas storage. And what we will see in the next slide is that our storage, which really helps prices into the winter, isn't anywhere near as full as it should be. And compare it to the last sort of 5-year average, we are sitting quite far below that. So I'm just going to go on to the next slide. Here we go. EU storage. Storage is running well below the 5-year seasonal average. As I say, I think the 12th of July, we're sitting at 51% of our gas storage in Europe. It is much lower than where we would be normally in July. If we have a bit of a look in this graph, tends to be around the 70-75% at this time of the year, moving into the winter season, which we would say is October through to February. That has a knock-on effect on prices. We then look and go, okay, we haven't got quite as much gas in storage into Europe. So if we do have any really cold snaps throughout the winter, prices can rise very quickly as soon as that cold snap comes along. Just to give you a little bit of an idea of why is it relevant for the UK. The UK isn't a major store of its own gas. We don't have a lot of storage anymore. And we rely on the interconnectors into Europe and the global markets to balance our supply here in the UK. So when EU storage runs light heading into autumn and into the what we would call the winter months from October, injection season buying intensifies and really pulls UK wholesale prices. Right now in the summer, this is that injection season right now. It is where we would tend to use to fill up the storage in Europe as much as possible during these hot months. We're using very, very little gas, and we should fill those storage up. The issue we're having, particularly with the geopolitical issues that we're having at the moment, is that there's not a lot of shipments, and the shipments that we are seeing are going to Asia at the moment. So that's just something to keep a bit of an eye on, and why again prices are a little bit elevated. Historically, a 10-point storage shortfall versus a 5-year average has coincided with notably firmer prices going into the winter for us. It is someone else's tank. We don't have too many in the UK, but it is still our price because we still get a lot of our gas coming through the interconnectors with Europe. So, as I say, the UK gas ultimately clears against the global energy market. Competition for cargoes abroad show up in the wholesale prices, and that happens within days, not months. So it is quite a sharp spike. Just looking into the forward curve, and I've mentioned it before, that 27 and 2028 are looking much more, they're much better at the moment, much more value in those periods. Procurement value is shifting and it's much further out. And the pattern that we are seeing, businesses still are buying purely the short term are quite exposed to these peaks and troughs at the moment. It's very difficult to predict exactly what happens on a given day of what's going on in the market, depending on the geopolitical events that we're seeing. Those structuring for 2027 and 2028 contracts now are locking in a large amount of volume, which is great. Pricing is comparatively favourable in 2028 and already sits around 40% below 2026. So the gap between near-term and 2027 and 2028 prices reflects on genuine supply growth and not just sentiment. This is not a call to lock in right now. I'm not saying that we have to lock in large, long-term fixed contracts. It's about just being aware and being clever. If you're a very large user of gas or electricity, we can start to look at, let's look at flexible contracts. Let's look at how we can protect you against these peaks and troughs and everything there. There's lots of opportunity to be able to manage your risk profiles through this volatile situation. And the team here at ARO have done an incredible job over the last number of years and managed really big customers through Russia or Ukraine and saving them a lot of money. So there are things that we can do to help and support everybody. Just to give you a bit of an idea, why are we seeing this? So winter 2026 really carries the highest premium due to the near-term supply risk. We're talking about Strait of Hormuz and the Norwegian flows coming in from the interconnectors across the North Sea. We're also seeing peak heating demand are priced in for the winter as well. So that's why the next 6 months prices are looking quite expensive. By winter 2027, the curve has already dropped by 30% to 86 pence per therm. And 2028 and 2029 are lower still due to the large amount of LNG that is going to be flooded into the market, particularly for the bits and pieces from Qatar. But we have to be very careful. We've seen Iran start attacking those Qatar LNG areas, and what we must do is to keep an eye on that. So prices are looking great at the moment, but it just takes the conflict to roll in for another sort of 6 to 12 months, and we'll start to see prices obviously affect them much further out curves. Market pricing today are geopolitical risk and near-term premium, not just a permanent feature. So just a few takeaways from everybody and what's going on. We deal with all sorts of people. When I am speaking to customers, I talk to sort of finance, procurement, and all their operations and facilities, and it's about how we can help and support everybody. So just finance, chief financial officers. What I've been speaking about and how we can help and support as well as model exposure to the Hormone style shock into your Q4 and Q1 2027 forecasting. And just keep an eye on those events and what's going on. We can help model financial budgets and bits and pieces, particularly around all your gas and electricity procurement contracts. More than happy to help on those. Procurement. Review where your current contract sits in the curve and understand your renewal dates well ahead of time. One of the most important things I speak to a lot of people is just don't leave things to the last minute. It doesn't matter what size of customer you are, how much you spend and use. It's speak to us, get in contact, and we can help. We can, even if you're 12 months out, we can still get prices now. We can have a look. That's not to say you have to sign now, but it gives you an idea of budgets. It gives you an idea about what's going on in the market, and we can then go through and build a plan around when we think you should go to market to help and support you. It's about being sort of proactive. You then use those prices, and if we start to see an opportunity in the market where prices have dropped, we're then able to act on that and help you out and advise you on the best time. If you were to wait until the last minute, and that happens all the time for lots of different reasons, people leave and other people take over and contracts gets missed, we can still help and support, but it opens up the risk. If you have to go to market and you're coming out of contract, say in July or August, it gives us very little time. If there's a big spike in the market, there's not a lot of wiggle room in terms of getting you the best possible deal. There's things that we can do to manage that. We can get a short-term contract that might be slightly higher, but then we can look at cheaper pricing going forward. Again, get in contact in plenty of time, and it just allows us to then manage the situation and help you and advise you in the best possible way. And people work in operations and facilities, I've worked with a lot of those, in particularly public sector and everything. Large multi-site customers, just keep a very close eye on your sites. A lot of people might be selling and buying new, particularly new sites. We'll look at all the contract exposure across all your sites, and it's managing that, and particularly using our software that we have, Pod. You're able to keep track of every single site when the renewal dates are up. We and the great account managers that we've got can manage those portfolios for you. We can look at coterminous end dates. We can add in new sites into your contracts and really help that. And the most important thing is just keeping an eye on for the winter. What we don't want is sites dropping out of contract and the risk of those and the increase in penalties and prices for those. So it's about keeping a really close eye on those sorts of things as well. So lots of really good information there. Just on to the next one. So I'm nearly finished. We are, as I say, this webinar is going to be a number of webinars over the next few months, aiming to help our current customers and new customers potentially, and just getting as much information out there as possible. What we're keen to do is, we've obviously got a bit of people will be on summer break, kids holidays, everything coming up. But when we're back in September, we've got another one talking about the winter months. What does the winter outlook? We'll have another update on the geopolitical events. I'm sure a lot will have changed over the next couple of months. And we can then talk about what decisions people need to make moving into the winter months and when contracts are up and everything else. So a lot more about what's going on in the markets going into winter, and that's in September. And then lastly, towards the end of the year, just before December, in 26th of November, we've also got a review of the year, what's happened, what to look out for in 2027, and everything that is still going on, and again, how ARO can help support current customers and new customers along the way. We're trying to get as much information out there as possible. Myself and the team, we're writing weekly market updates on a Monday that get published. We put that onto LinkedIn. It gets sent to our current customers as well. Just gives you a snapshot of what's happened in the markets over the last week or so. It's really interesting, and just keeps customers up to date with everything that's going on. energy can be pretty complex at times, but we're here to help and support. And the most important thing is just speaking to us and reaching out so we can help and support moving forward. So, has anybody got any questions? I'm just going to stop sharing. If anybody wants to also note down my contact number there and my email address, please feel free, drop me an email at any time, or give me a quick call. I'm more than happy, and I'll get back to everybody as quickly as possible. We're here to help and support. Any question is absolutely relevant. As I say, energy is rather complex, and we're here to help and support. So yeah, jot down my contact details there, and I'm more than happy just to help and advise. Even if you're in a contract, even if you currently use a different TPR or consultancy, we're still here to help. We can still look at contracts and help advise as a sort of no obligation there. So yeah, more than happy to help out. I'm just going to stop sharing and I'll see if anybody's put any questions in the chat. Okay. Right. Let's have a look. How can we predict better value in 2027 and 2028 when the world is so volatile? Good question. The most important thing, what we're seeing at the moment is 2027 and 2028. The value right now is not risen anywhere near as much as the short-term contracts at the moment. So there is value there. It's only risen a very small percentage that we're seeing because the analysts and the experts within the markets are pricing in short-term volatility. So what we're seeing is right now, near-term prices are very volatile. So we see the peaks and troughs here. But if we start to look at 2027 and 2028 contracts, they've not risen anywhere near as much. So the value right now is there. The more interesting part of that, and what you're sort of alluding to as well, is we're having to keep a very close eye on the current conflict and everything that's going on in the market. Because if there's any reason that this might go on long term, a little bit like Russia-Ukraine, that is still happening to us now, which is terrible, it will start to have a knock-on effect into 27 and 2028. We're not seeing that right now because prices for those periods haven't risen anywhere near as much as the near-term ones. So that's how we're starting to see that value there, which is the important part. It could quickly change, and that's why I say get in contact with us as quickly as possible, far out from your contract end dates, because we can look at when to go to contract and what to do. That's the most important thing, where the value is and where you're going to get the most benefit from. So hopefully that helps. Supply growth expectation. Do you want to just allude a little bit more, Richard? Do you want to put, when you mean supply growth expectation, do you mean how much growth of? I think is probably what I'm after. Jade, if the Strait reopens, is there somewhat return to normal? Yes, absolutely spot on. What we are seeing is if there's any good news story, if a ceasefire is agreed again and Trump gets Iran to the table and we start to see a ceasefire or any good news story, if the Strait is completely reopened and there's no attacks to shipments, we are seeing prices drop very quickly, just as quick as they rise. So that's what we're saying is the risk right now, and the sharp peaks that we're seeing is the real near term. It's right now. That's the key thing. It's been managing the next sort of 6 months that we're seeing. So prices will reduce with any sentiment of good news. Trump very quickly a week ago said that he ceasefire is off the table, not going to do anything of it, and he is going to go in and start military operations again in Iran and everything there. That happened over a 24, 40-hour period, and now over the last couple of days, he's actually now said, "I'm absolutely open to negotiations." He wants to come to the table. He wants Iran to come and meet and agree another ceasefire. And as soon as we saw that, literally within 24 hours, we saw prices drop by about 5%, which is great news. So we are seeing things reduce very quickly, which is great. So it is. It's not to scare or worry. The risk is right here and now. It's not long term, and we're not seeing week on week on week of prices rising and no falling. What we are seeing is the spike with a very, a terrible news story. Shipments might have been attacked, prices rise. Then what we're seeing is things die back down again, and we're starting to see prices drop again. So it's just being a bit careful and savvy about what's happening at the moment. So, yeah. Storage from do we have a view on how much new supply is coming to the market? Yes. So Richard, there is an unprecedented amount of LNG coming to the market that has been agreed with Qatar over the next 5 to 10 years, which is great news. And that is helping 2027 and 2028 prices and further out. It is keeping those prices nice and low. The issue we have that as well is that Iran almost know that. And if they were to then attack the facilities in Qatar further and take them offline, then that's when we start to see issues in the market and prices rise much further out. Because a lot of that agreement and a lot of the shipments that have been agreed over the next 5 to 10 years might get knocked back further because of facilities that are taking offline. So we have to be very careful and keeping an eye on that. But at the moment, there is a lot more energy supply coming online from Qatar for 2027, 28 and further out, well into 2030 and beyond. They are tripling and quadrupling their supply year on year over the next sort of 10 years, which is great news and helping the further outlook, which is great. And it is keeping those prices further down. So yes, we are seeing that. We're also doing a lot of sustainability and regeneration here in the UK. Solar, wind turbines, all those bits and pieces as well. We're really trying to become much more sustainable here in the UK, which is helping. The further we can get away from using gas-fired power stations to supply our electricity, it helps. It makes us more sustainable here in our lovely country with wind and everything else. So then that helps as well. There's a lot of work going on behind the scenes on that side of things as well, which is always a positive area. Hopefully that helps. Does anybody else have any questions at all? Please feel free to. No, it doesn't look like it. I just wanted to take a couple of minutes to say thank you very much. I appreciate 10 o'clock on a Thursday in the middle of the week. People are very busy, so just to keep, just to say thank you. As I say, you've got contact details here. We'll send out a quick email of thanks and just to make sure everyone's got those details if anybody has any questions at all. And we're here to sort of help and support. As I say, it's not a huge scary outlook. There is some volatility in the market for the next sort of 6 months. Further out than that, things are looking much better, as we've suggested. So it is about just being very clever with your strategy. The most important thing is it's not the people get in contact within plenty of time. They're the ones that we can work with the most, and that's the most important thing. Looking much further out, looking at contracts sort of anywhere sort of 12 months out, that's the most important thing for now. So thank you very much. Really appreciate everyone joining, and we will see everybody in September. Please feel free, use the QR codes. We will send them out to everybody, and you can sign up to the next ones as well. So